Okay, ladies and gentlemen, welcome back to MACROACE with your host Tony. This time going through the Bank of Canada. Let's get into it then. So, how does it affect the markets? First of all, with the currency, if the central bank is more hawkish than expected with their commentary, or if they decide to raise interest rates more than expected, or if they do raise interest rates when they're not expected to raise rates, then that can lead to a bullish reaction to the Canadian dollar. So remember, the key thing is we're not just looking at the rate itself, but also the statement that comes with it and anything else that comes alongside it too. And in this case, with the Bank of Canada, they're also going to be releasing their monetary policy report alongside their rate statement. So that extra information that we get from the Bank of Canada will help to provide more information as to what the Bank of Canada expects, not only for their rates, but also where they see the economy as well in the future. Then for the stock market, if you do see the central bank being more dovish than they're expected to be, that could lead to more of a bullish reaction from the stock indexes and stocks in Canada, because if the markets are expecting the central bank to, if they expect the central bank to put off a rate cut decision for when the markets might have previously expected them to, and they become dovish instead, then that would be a nice welcome surprise, and in turn lead to repricing of the central bank rate decision for the future, and then in turn provide that bullish reaction. And for bonds, if you do see the central bank being more hawkish than expected with their commentary, or if they do decide to raise interest rates at any meeting, but in this scenario, if they decide to cut rates in this meeting, which will be very early and no one's expecting that to happen, then you would see a decline in bond yields and a rise in bond prices. Because remember, when interest rates are raised, or the central bank is more hawkish, bond yields will go higher because rates were staying higher. Or it's the fact that, it's that the central bank may be looking to raise rates again, or continue raising rates, and in turn, what happens is bond yields will then go higher instead, in anticipation that the central bank has more work to do. So where is the economy at the moment? CPI at 2.8% compared to 2.9%. Core CPI, or the CPI trim, 3.2% compared to 3.4%. GDP quarter-on-quarter annualized at 1% compared to Q3 of minus 1.1%. Employment change, what we had last week at minus 2.2K compared to 40.7K. Average hourly earnings was at 5% compared to 4.9%. Unemployment rate at 6.1% compared to 5.8%. That's also going to be quite key when we're hearing from the Bank of Canada, is how much do they shift their rate cut expectations, and or are they willing to shift their rate cut expectations if the unemployment data came out weaker than expected, and in terms of being higher is what I'm saying, that that is weaker than expected at 6.1%. Then continuing on with retail sales at minus 0.3% compared to 0.9%. PPI was stronger at minus 1.7%. RMPI, or the raw material price index, month on month is at 2.1% compared to 1.2%. And manufacturing PMI 49.8 compared to 49.7, so not really much of a change there, but still within the contractionary territory. So remember, a figure above 50 or above shows the economy, or that sector of the economy in expansion. Anything below that shows contraction. All right, so if we look at the previous Bank of Canada rate decision on March 6th, so the prior rate decision in January, the central bank said that they expect inflation to remain close to 3% in the first half of the year, easing to 2.5% in the second half, and then returning to this 2% target in 2025. In October, they said it would be hit by target by the end of 2025. They also said back then that Canadian growth likely to remain close to zero through Q1 2024 and will gradually strengthen around middle of 2024. Now, the latest central bank statement from the Bank of Canada is they said it is still too early for the bank to consider cutting rates. And off the back of that, the Canadian dollar had strengthened. They also said there have been no big surprises since January rate announcement. Economic growth has remained weak and inflation has eased further. Shelter price inflation remains elevated, and more broadly, underlying price pressures persist. Domestic inflation could prove more persistent than expected, and they're still concerned about the risks to the outlook for inflation, particularly the persistence in underlying inflation. And then the meeting minutes in March 20th, not too much to really garner from it, but they said that indicators of underlying inflation suggested slow progress getting inflation down to target. Members also had differing views of how to weigh risks to the inflation outlook, and recent housing market data suggests shelter price inflation likely to remain the biggest contribution to total CPI inflation. So similar to the Fed, having a focus on the housing or the rent side of inflation is also becoming a key narrative within the Bank of Canada too. And you've seen that with some of the other central banks too, talking about housing and rent costs. You probably will see that coming through the ECB on Thursday. You do get a lot of, to a degree, when I say a lot of, you do get a lot of correlation where you see the Fed talking about maybe a certain particular point, a data point, and then other central banks being influenced by the Federal Reserve can also take on that view too, or that rhetoric to a degree. And we're seeing that with the Bank of Canada too in their last meeting minutes and rate statement. Bank of Canada views, Macklem said March 6th that the bank needs to see further and sustained easing in core inflation, and that we're going to be taking our rate decisions one at a time, and we will take our April decision in April when we will have the benefit of more data. And then Gravel said that February inflation data was very encouraging on March 21st. Sentiment and views, CIBC said that the Bank of Canada can't sound too dovish if, as they expect, they leave rates on hold, because that would have some questioning why they didn't cut right now, particularly with the jobless rate sporting a 6 handle. So they say to look for dovish language on inflation to be countered by an upgraded growth forecast for Q1. But given the pleasant surprise in inflation, the statement won't close the door on a rate cut in June, with the bank signaling that they just need a bit more comfort that a softer underlying CPI trend is well in place. Goldman Sachs said that earlier this year the unique feature was that US was planning to participate in the cutting cycle despite stronger activity data. Now it is becoming increasingly the case that the Fed is not alone in this, and central banks everywhere seem undeterred by stronger activity and are still largely on track to start cutting in 2 months. Also from Credit Agricole, they say on the 5th of April, they see a stronger chance of the bank cutting rates before the Federal Reserve does. That is primarily because Canadian inflation has recently softened by a greater and broader extent than initially expected, as it remains to be seen whether the new monetary policy report will still contemplate a return of sticky inflation above 3% in the next few months. So that's something to be aware of. So the key point is, do they still see inflation being sticky within the next 3 months, if they still see it at 3%? If they do, then that could provide some support to the Canadian dollar within the markets, But if they don't include that point, or if they see it at a lower figure, then that would provide a more dovish reaction and bearish reaction for the Canadian dollar instead, because that means that the central bank is then more willing and open to a rate cut in June rather than pushing it out to later. Also, one final bit of commentary from MUFG. They say that the Canadian rate market is currently pricing in around 21 basis points of cuts by the bank in the June policy meeting. Anything less than a clear signal in the week ahead that the bank is teeing up a rate cut at the following meeting in June could trigger a relief rally for the Canadian dollar, i.e., if they don't mention that inflation is if they still see inflation being sticky at 3%, or if they repeat that they need to have more confidence before they consider cutting rates. Those will be the only times, or that'll be the only time when repeated comments, when the sentiment has shifted, has more weight within the market and can cause more volatile moves if the central bank isn't shifting to what the markets are expecting them to do. This is the last report then or the last market reaction from what we've seen in the Bank of Canada. Let's just so this is about 10 seconds before that. So I'll let it run a little bit and we'll see how the market's reacted here. Okay, so from that, you'd seen a strong reaction from initial strong reaction from the Canadian dollar, the strengthening there. And then as we kind of carry on, let's bring that out. See that movement is, so you can see they're taking a couple of trades here, or a trade there on GBP CAD. And we're also, let's just kind of move forward a little bit. We can see that it was a little bit, there was the initial trade that I'd taken, which had done nicely. You can see where around the blue line where that is on GBP CAD. If I kind of just skip ahead a little bit forward, and then so then it continued its downward momentum. Then on, if we kind of skip ahead a bit more, it kind of sustained it. Let's kind of go back a little bit. There was still something that was there, but we'll go through that in the ranges and deviations. But as I said, seeing that the Bank of Canada, the reason for the Canadian dollar strength was because the Bank of Canada said it is still too early for the Bank of Canada to consider cutting rates, which went against what the sentiment was at that time of expecting the Bank of Canada to set themselves up for a rate cut decision before the June meeting. If we keep going, and you can also see that Canadian money markets see 23% chance of a Bank of Canada rate cut in April, down from 43 before the rate decision. Keep going. You can see here that the market reaction was sustained. But one thing, well, let's get out of this here. One thing I want to go through for the Canadian data for Bank of Canada is here with the last rate decision, the market reaction. You can see that the market reaction wasn't as strong as it was on the initial market reaction before for GBP CAD, but it was more sustained. So you can see, if you kind of skip to the right, that with this sentiment column here, I go through and note what the sentiment was and why the Canadian dollar had reacted the way that it did react, which is very useful when it comes to reviewing shifts in sentiment and shifts in narrative or rhetoric from the central bank. Here, you can see that they said, it's too early for them to consider cutting rates. Macklem said they need to see further sustained easing in core inflation. And money markets also more or less kicked out the idea of an April rate cut happening from the Bank of Canada from that rate decision. So you'd want to, if you were looking for a bearish reaction from the Canadian dollar, you wouldn't want the central bank to say that it's still too early for the Bank of Canada to consider cutting interest rates. Okay, that could, if they still say that, then that means that the Canadian dollar could see some support instead and could sustain a bullish market reaction, albeit not that strong because it's been said before, but it does keep off the chance, in that case, the idea of a June rate cut. So here, the biggest market reaction that we had seen was from GBP CAD, as has been in the past as well with the with the Bank of Canada rate decision. So you'd seen here initial move of 27.5 pips down on GBP CAD. After about 10 minutes of the release, it was down 41.5, and after about 30 minutes in the blue brackets, it did reverse a little bit, but was still down by 34 or 35 pips. Then you have the Euro CAD and Dollar CAD had seen the next biggest market reactions. Okay, so as said, hopefully, so what we're looking for from the Bank of Canada then, as we'd seen with them before, if I just kind of... So of course, as said with the Bank of Canada, that they would be looking at the central bank, whether in their monetary policy report still contemplates sticking to the idea of inflation being sticky and remaining above 3% in the next few months. That would be probably the key point. And then, of course, if they repeat the language for the bullish scenario for the Canadian dollar, and if they repeat the language that they still see inflation, that they still feel that it's too early for the central bank to start cutting interest rates. Now, the Bank of Canada have had a couple of surprises here and there, where they may have raised rates by more or less than what the markets have anticipated. So there could be a surprise, maybe, and I'm not going to put it off, with the Bank of Canada if they decide to start their rate cutting cycle at this meeting. So here's the reason as to why the Bank of Canada could maybe start their rate cutting cycle sooner rather than later, and why they could surprise the markets is because of these three releases here back in July 13th, October 26th, and June 7th of 2023, where they've surprised the markets by either delivering a bigger than expected rate hike or smaller than expected rate hike. This is something that we need to be careful of with the Bank of Canada, that they could surprise the markets. I'm not saying that this would be enough to then see a rate cut from the central bank tomorrow, but the fact that the central bank has surprised the markets and gone against the grain is something that we need to be cautious of. You can see here that when they have surprised markets, the market reactions have been much bigger than what you have seen in the past, or more or less outstripped what you've seen in the previous market reaction. You see here the last biggest market reaction was back on June 7th, back in 2023, when with the central bank raising the rate to 4.75% rather than 4.5%. So this is something that we just need to be careful of and aware of with the central bank with the Bank of Canada. But the likelihood of that happening isn't very high, or more or less non-existent, with, of course, of what they said at the last meeting. But it doesn't mean that they can't. Well, and that goes with any central bank. Hence, rate decisions provide a huge opportunity for day traders to be able to capitalize on, because of the uncertainty of what can actually happen. It's never straightforward. If it is, I wouldn't be talking to you guys. I'd be on an island somewhere enjoying a strong glass of orange juice, freshly squeezed. But anyways, so hopefully you found the information useful for the Bank of Canada. Don't forget to give the video a like, subscribe to the channel, share the video with your fellow friends and traders. Get the word out there. If you've already subscribed to the MACROACE main list and you've got access to the ranges and deviations sheet, push your friends to subscribe to the MACROACE main list. Get them to sign up. Thursday, as said in the previous video, I'll be doing the ECB rate decision. So that will be a live stream. But for now, enjoy the rest of your day or your week, and I shall see you Thursday.